higher in the 21st century. Hard-working people working hard for you and me. Moving higher, time and time again. Through the years you'll find us here. Moving higher.
Hello and welcome to Moving Iron Podcast. This edition of Moving Iron Podcast is brought to you by TractorZoom, delivering insights. And this is our monthly sit down here with the folks from TractorZoom and Kyle McMahon and talking about what we see happen in the auction market. And this is about 2 months into this. I wish it was only 2 weeks. 2 months into this COVID-19 kind of lockdown thing we have going on, and most of the overwhelming majority of the auctions now are being kind of done through the timed auction, online auction aspect that we see. Some folks are still doing some calling that you see, chain stuff, but the overwhelming majority of it switched over to an online kind of timed auction aspect. So, Kyle, as you take a look at these last couple of months, what do you see happening out there? And have you talked to any auctioneers that have kind of expressed, the next 30 days we're going to go back to a live setting?
Yeah, I mean, auctioneers obviously love to bid call. They love to chant auctions. That's what's the thrill and adrenaline rush for them. So yeah, naturally they want to get back calling live sales, but they also know they need to do what's right for the sellers. And if the sellers are a little uneasy or they're not wanting to bring crowds back, that could spell disaster. So auctioneers are definitely take it day by day and understand what's going on in the market before they start to call live sales again.
Okay, so with the exception of a handful of auctions that got canceled or dates got moved or those kind of things, for the most part, auctions have kind of stayed the course. The number of auctions obviously has fallen off a little bit, but not like you think it would have. So I guess as you look over the last couple of months and what you've seen happen in the health of the auction marketplace, I guess what are your takeaways so far here coming into mid-May?
Yeah, so I'm going to share a couple slides with you here that can help form the decisions that we've come to. So we can always have opinions, but we as a company, and me personally, always like to use data to support those decisions or opinions rather. And what we've really seen in the market, if you were to split the United States in half, east, west, out your way, Casey, we didn't see a whole lot of postponed auctions. And the auctions that did happen, they had some online capability. But as soon as you start getting out east, call it Ohio, Michigan, the Carolinas, we did see a lot of auctions postponed. And this graph represents auction inventory over the last year and a half or so. So starting January 2019, as you can see on the left-hand side of the graph here, keep in mind our business has grown significantly during this time on the number of auctioneers that use TractorZoom to advertise their auctions. We were at about 200 auction companies at the beginning of 2019, and we're a little bit over 400 auction companies that advertise and use TractorZoom services today. So this is auctions by type. So you got your consignments, estates, liquidations, and retirements. What we saw in March 2020 was a lot of inventory. You recall, Casey, COVID was still kind of just starting out. People were deciding, do I shut down business? Do I not? And then as you see in April 2020, we had a drop off. If you look at April 2019, it was still increasing in auction volume. So what we saw was a negative reaction from COVID. We specifically had tracked 55 auctions of the, in March we saw 355, and then all of a sudden 55 auctions in April were postponed or delayed until later this year. A lot of those were retirements or estates where they had the flexibility to delay them. A consignment auction is a little bit harder to delay, and you kind of have to figure it out because sellers have probably been bringing an auction inventory to your yard for the last several weeks. What are you going to do? Tell them to take it back home and we'll sell it again later this year? Right. No, you're going to figure out technology, and you're going to you're going to get it sold for them. But retirements to states had flexibility. Some sellers were nervous of low prices, which we didn't really see, but they pushed that out later this year.
Okay. So I have a question real quick, just for the audience here. Will you define a consignment, an estate, liquidation? I mean, how do you guys define those four categories?
Yeah, definitely. So one of your most primary types of auctions is a consignment. That's an auctioneer saying, hey, March 31st, I'm going to have an auction. Any seller can bring any piece of equipment and we will sell it for you. On the reverse, you have an estate or a retirement sale. Estate, somebody died, kids are liquidating the farm. Retirement, maybe a farmer's getting old or he's tired of $3 corn. And so he says, you know what, I've been farming for 4 years. I'm hanging it up this year. There's no sense in farming for no profitability. And those type of auctions, estate and retirements, is a specific auction event for that one seller.
Okay.
And traditionally what we see in that, Casey, is the local crowds will actually attend those in larger quantities, because frequently what you'll see is that's a little bit nicer equipment. It's a full line of equipment versus a consignment where kind of the red flag goes up in a lot of buyers' minds saying, well, what's wrong with it? Who's the seller, right? Let me talk to them.
Yep.
And then liquidation, you actually see a spike in March. We saw a lot of farmers downgrading, having liquidation auctions, or a couple of farmers getting together and liquidating some equipment or unused or unnecessary equipment. So liquidation is either forced liquidation or kind of a downsizing auction, and you can actually see here we saw a lot of them.
Yep. Okay. Good deal. All right. Makes sense to me. All right, buddies. What's next? What's the next one?
Yeah. So what I thought made sense, Casey, is to go through what we're seeing in three of the largest asset classes within farm equipment: tractors, combines, and sprayers.
Okay.
So here, this slide, you see obviously tractors. First thing I want you to see is there's three classes we have here: 300 horsepower and above, your middle row crop, and then kind of your hay and forage, 100 to 174 horsepower. And you can see the volume of sales on the top graph, and then the price of each on the bottom graph.
Okay.
We see throughout the year big seasonality, right? So there's not a lot of machinery moved at auction during plant and harvest.
Right.
You naturally see auction inventory spike pre-plant, which is that February, March, April time period.
Mm-hmm.
Pre-harvest, which is that really July, actually August and September is the biggest months. And then your post-harvest, grains in the bin, farmers know how much money they made. They need to play the tax game with Uncle Sam. Let's go spend it on some depreciable assets, machinery. And you frequently we see December, the biggest auction season of the year.
Right.
So what we've seen in tractors in the last year, Casey, is you and every listener probably knows it's been one heck of a volatile 360 days here, 365 days in the last year. Last year, as you can see, the middle of the year, in like June, July, that is obviously we had some 450 corn at that time when the markets rallied because it was so wet. But we've been up and down, trade policy, MFP payments, wet weather, 450 corn, 360 corn. Now we're at 290 corn, right? It's been the era of volatility, in my opinion. And we kind of see that with tractor prices. So the best indication of what's going on in tractor prices is to look at the peak volume seasons. That's when the most inventory is traded, and that's when you get the best broad spectrum, if you're looking at an overall asset class, to understand price. So what we saw going into planting last spring 2019 was some strength in the market, and then obviously going into the season we saw it dip down. So from 111,000 on average to 92,000, and this is for 300 horsepower tractors and above, dipped down roughly 20% from spring 2019 to summer 19. And then all of a sudden, end of 19, we had three things going for us. Yields were bigger than expected. MFP payment was guaranteed at that time. I think the first check might have been written or was planned to be written to farmers or deposited in their accounts. And number three is trade policy seemed like it was going to get done. Mm-hmm. And then COVID hit.
Right.
What I really want you to look at, or everybody to look at, is that March 2020 volume, and then all of a sudden volume dropped off significantly in April. We didn't see that in 2019. That's what we believe postponed auctions. That lack of inventory held prices up better year to date, April over April, fairly well. So roughly, I think 15% higher from April 19 to April 20. We believe that is from an inventory shortage in tractors.
Okay. Doing some math here real quick in my feeble mind, but look at something real quick. So it's about 6%. So I was just looking at the down on the average price gap there. So in January, so basically in that February time frame, the average price was 111,000. And then if you fast forward to about December time frame, it's 118,000, about a 6% price increase, and a year over year. I wonder how much of the actual manufacturer's price increase played into that, propping up used equipment to some extent. Will be there. The other flip side of that too, the three things you lay out there: MFP payments, trade, and what was the other one you said? MFP, trade, what was the
Bigger yields.
Bigger yields, yeah. The other part of that too was in that June, July time frame. That's when we had that 450 corn thing, and a lot of guys were forward contracting their to the December contract. And a lot of that, I think, is what we saw that first quarter of the year be so impressive with the amount of action we saw at the dealership, with just some carryover money. And also, if they've got a few extra coins in their pocket, they're going to pay a little extra for a piece of equipment that's the one they want. So I think that had something to do with it as well. So that was that end of the year thing, like you said, it was like a perfect storm of things that kind of took place there for just a very short amount of time. And we saw a pretty decent spike there in overall volume at the auction.
Yeah, yeah. So I think these aren't too wild, crazy, volatile prices as you might think. Commodities were swinging much greater than the machinery prices. So machinery prices aren't directly following corn prices, but commodity prices are obviously a big influence on it.
Yeah. Yep.
So as we go into combines, a little bit more volatility here.
Boo.
Yeah. So, Casey, we've chatted about combines. I've listened to a bunch of other podcasts, you and Aaron. I think I was on a flight going down to a conference listening to you and Aaron talk about lag in the market last maybe August during combine season. Well, now we can actually put data to it. Last summer, that August time period, there was a massive bulge of combine inventory in the market.
Yeah.
And you can directly see that center of the graph on the volume of combines that were brought to the market. The crazy thing I see here, Casey, is if you look at the average price in July of 19 at 48,000, there's not a ton of volume, maybe kind of normal for that July time period. July, probably not many consignments going on, so there's some good retirements. And guys are probably feeling good buying combines at that point in time, just come off a 450 corn run.
Yeah.
And, they knew there's going to be more combines in the market as auction sale bills were getting posted and inventory was getting publicized. But then I think there's way too many combines brought to market. And that August, what you'd think would be an August peak, we saw a price lowering of maybe 8%. in the month of August, and that has to be led to the sheer volume of combines sold.
Yeah, it's a textbook supply and demand issue there.
100%.
There's so many used combines out there, and I can't keep saying that. There's so many used combines in the marketplace, which is true, but it's a certain segment that there's too many of, and that's the 12, 13, 14 model years. Whether I don't care if it's Deere, Case, New Holland, Gleaner, I don't care who it is. They're all have a proportionate amount of those machines are all there. And the problem is, it's not the fact that there are too many machines out. The biggest issue is that the amount of machines that are hitting the lot are that. I mean, there's just so many of them that haven't gone through that traditional trade cycle of every 2 years, or every 3 years, or every 5 years, or whatever it is.
Yeah.
Everything is a 5 or 6 year old machine, and it's got about the same number of hours on it, and it's about the same kind of spec, and blah, 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 blah. And next thing you know, it's a commodity now. You know what I mean? If there's just, I want a bushel of corn. Cool. There you go. There it is. There's the price. I want a 2013, blah, blah, blah. Here you go. Here's the price. There's no differentiation between. That's what drives me a little crazy about my own statements of there's too many combines in the marketplace, because there's not too many 17, 18s, and 19s, right? It's that segment, that one segment that is there. And the 4 15s and 16s are kind of tweeners. You know what I mean? That was during the time frame when there was not very many of those made either, but they're also old enough now to where they're kind of starting to fall off in value, and they're kind of getting lumped into that other thing. So it's a mess.
Well, you must have had a lot of people listening to your podcast when you're talking about combines being down in the dumps, because everybody probably thought it was time to buy a combine when it came to December. And natural auctions have it, competitive nature. Mm-hmm. It kept driving value up.
Yeah, and there were prices on that. And when Sullivan had their December auction, consignment auction that they've had, some of the prices that were coming there, I'm like, there's no earthly way they're gonna, because they had this row combine. I was like, man, this guy's sorry about their luck. But man, they brought the money, and you saw that auction after auction, basically from the like your graph shows it here. It started out in November and it took off to December, and it kind of trickled down to that February timeframe, which your mid-November to kind of mid-February timeframe was really the meat of that jump. You know, obviously December is always the best time usually always the best time to sell that combine on an auction, just because of trying to get over on Uncle Sam. There are some tax issues, but the long run of that story, just in my opinion, is just there's just too many of a certain year range that we've got to figure out what we're going to do with those machines. I don't know.
Well, will we ever? There's just so many out there. Yeah. You don't see them going away for a couple of years. And like you're saying, there's still a shortage of more late model, lower hour combines, and that's where you see strength in the market.
Yeah, I think, in my opinion, the real answer to getting rid of these older combines that specific year is it's international business. They're relying on the South American and Mexican marketplace to buy the 60 series and the 50 series and the 70 series combines, and a lot of those guys are showing up now, actually seeing some of these S series combines, these that are actually worth. They've come down in price enough where they can afford to get them, right? If you take a look what's going on in Ukraine, and take a look what's going on in other Eastern European countries, there's opportunities there, but it all comes down to who's got money and who's got cash flow, and who can pay for it, and all those fun games that come along with the international marketplace. But to me, I feel like the North American marketplace is saturated with those year models worth combines, and it's got to be until that gets figured out. It is what it is, and we have to free up some space somehow. And unfortunately, it's going to be a tough ride for a while. I just think it's going to be they're dragging down the rest of the marketplace with them.
Well, the other takeaway I take from this combine pricing over the last 15 months is, if you're a seller, be selling in December. you're a buyer, be buying the first quarter or third quarter.
Mm-hmm. Which that makes sense too, because most folks are, when they're buying their that December, January, February time frame, they're making their purchases for that year, and what they need to replace for the year going into harvest or planting or whatever it is. That makes a lot of sense. I will say though that July time frame that you have there, where you have the spike up in count as well as a little bit of a spike up in price. Excuse me. That time frame is post wheat harvest rolling into fall crop harvest is you do see some attractiveness there, and those are the folks that are they've got their grain in the bin and they're trying to make some decisions about what they're going to do, if anything, moving forward. So that was an opportunity as well. But obviously, as you can see, I'm sure if you put this graph up for the last 3 years, that $68,000 number would still be the highest point on the chart for sure, over a 3-year average.
It certainly very well could be.
Yeah.
Okay, so the other asset class to look at was sprayers. The thing that surprised me a little bit by looking at the data here was there's really only 2 peak seasons for sprayers. Yep. You don't see sprayers, according to this, you don't see sprayers trading in that pre-harvest. They're just getting done with use from maybe a month before, but we just don't see many sprayers on the market in that August pre-harvest auction season.
Yep.
However, big sprayer season, December and March.
Yep.
We saw a little bit of weakness from probably that December, January time frame of 2020 versus the December, January time frame of 2019, 18-19. Saw a little bit of weakness, but once we got to March 2020 and then April 2020, we saw strength as it relates to the year prior in 2019. Even though there's a lot of inventory on the market, we saw some strength April over April, 19 over 20, by roughly 9%. So in the month of April in 2020 was 9% higher than the month of April in 2019.
Yeah.
And 2019, April, the big rains hadn't come yet. So you can't say it was wet weather.
Right. Yeah. And I think that's pretty typical if you look at the range there. Year-end buying, obviously. There's nothing left to spray, right? In November, they sprayed everything they're going to spray. So they're looking at upgrading of what they've got. And also, if they haven't done that in November, December timeframe, going in before they start top dressing wheat and those kind of things, you start seeing it spike up there as well, going into fertilizing applications for corn as well. So corn and beans. So yeah, you see that spike up from January to March too. So I would agree with what you got there, and I would say sprayers have been a bright spot for the last 2 or 3 years. As far as value goes, it seems like good used sprayers were in somewhat of a demand cycle, and there weren't that many. There weren't that many lower hour ones, just like same combine situation that we saw. They talked about this a minute ago. People just held onto their sprayers and put more hours on them than they typically would have, or picked up some more acres, than they would have typically done. Those kind of things. So the hours and spray hours on these machines had kind of hit the saturation point again. And again, there's a big chunk of them that have relatively close to the same hours on them.
Yeah. Yeah. So as it relates to kind of wrapping up these 3 asset classes, we look specifically April 19 versus April 2020.
Okay.
Year over year during the COVID month of 2020, we saw a strength in the machinery market on all 3 asset classes. Tractors up 14%, combines up 5%, spraying up 9%. We believe this is due to inventory shortage at auction. Buyers saw the piece they wanted to buy. They saw it in March. Auction was going on beginning of April. Auction got postponed. Well, I got to go find something else to buy, or I'm gonna have to just sit on something else. I think it created more of a competitive atmosphere in the auction market.
Yeah.
So low supply is what we believe stabilized this. We'll have to see what goes on later this year once that inventory comes back on the market.
Mm-hmm.
The other thing I want to make sure that people understand through these numbers is these are an overall average. So the 14% in tractors, that's 14% for 300 horsepower and above tractors, all makes, all models, all conditions, but it gives you a good understanding of strength in the market.
Right.
Combines, same thing. It is every type of combine, every color of combine, every year of combine, and every condition. However, it gives you a lens to look at the strength in the market and the combine market. Same with sprayers, right? So they're all self-propelled sprayers as it relates to strength.
Yeah. That makes sense. That's good data, man.
Yeah. So thought it made sense to share these numbers with everybody because it can be a little bit depressing if you're just watching the Chicago Board of Trade. But you look at your machinery in the shed and maybe you feel a little bit better about yourself.
Yeah. Yeah. I think just we hear this stuff and the doom and the gloom and those kind of things. I just feel like we're coming out of the trough here. I feel like we're going to be going up. I'm not saying there's going to be $6 corn and $13 beans or anything like that, but I'm just saying, we're going to see a significant rise in value across the entire all segment. So I really feel like there's a great opportunity here for folks to set tight, and you're gonna have some money in your pocket. So just stay tuned, I guess is the best way to do it. Yeah,
Casey, I'll have to do the same kind of conversation as it relates to these three asset classes and machinery.
Mm-hmm.
And heck, we could do it in June and July and August again and just see how this is trending. Maybe there is more optimism in the market. We get some higher commodity prices. We get cars back on the road, ethanol plants back online, driving commodity prices up.
Yep.
It's going to have an impact on what machinery values will do. And it'll also change farmers' kind of optimism in the market.
Yep. I think there's a lot more optimism out there than what the media wants to portray. I know it's a tough time right now, and I know there's a million things that say that this is going to be the worst time ever, but I really feel like there's more optimism than what the actual media is letting you know.
Yeah. Well, should we move into a little bit more granular what's going on in the combine world?
Yeah, let's do that.
We might make this long enough to where we could make it to two podcasts, Casey.
We could. Definitely could do that.
All right. So as we dive into the combine market, I saw, naturally saw the volatility in the slides that we had shared before. Boy, you got some bad transitions here. Auction inventory again was significantly up in March, and then April was postponed. As we look at the combine market, as we were saying earlier, we saw that a lot of volume had an adverse impact on combine value in August 2019. And we saw those prices rally fourth quarter. As we had mentioned, commodity prices, they had an opportunity to sell in the summer. The MFP payment came out. We had bigger yields than expected, and maybe some trade, some foreign trade was looking optimistic at the time. And as we look at all combines by manufacturer over the last few years, we wanted to put a chart together that specifically shows the average price per manufacturer. This is for, I don't think it gives you any great intelligence what's going on in the market, but if you're specifically buying you're hardcore John Deere, hardcore Case IH, hardcore Gleaner, whatever you might be, this shows what the used value of those combines are going to do over time. So as I look at this, Casey, John Deere's on the top. So all auction results are favoring John Deere combines, and you can see that linear graph there representing combine. The order it goes is John Deere, Case IH, Kloss, New Holland, and then Gleaner ways down there.
Yep. Yep. Another interesting thing about your chart is the number of machines that are under 50 grand. That Jackson Pollock painting you have down there under 50 grand. You know what I mean? There's a lot of machines down there.
There are a lot of machines. And something else I kind of thought was a little bit funny is, Casey and I used to sell John Deere equipment. Nothing runs like a Deere. Look at those combines that guys are stretching out between 8,000 and 11,000 hours.
Yeah, no. That's a lot.
That's a lot.
It's a lot. But you see a lot of machines out there. I mean, I know we've looked at some older like 9600s and looked at some 50 series machines that have got 5,000 and 6,000 separator hours on them. So I'd put them up there in that 7,000 to 8,000 engine hour range. So that would be out there. But there's the one surprising move on this chart here that I would find that I was a little bit surprised by was the linear nature that Kloss and Case have to each other. They're really not that far apart, and actually Kloss towards the tail end of its lifespan actually outpaces the Case as far as value goes.
Yeah. Yeah, it certainly does do that. But, there's a lot of data points here, a lot of combines that we've tracked that have sold at auction. And I think this really paints a really good picture of what values do if you're hardcore one brand or the other.
Right.
And if you're ever to switch, this will help show you what used values by paint color are doing over the life cycle of an entire combine analysis.
And the nice thing about this too, to all you bankers out there listening to this shows you bang for your buck and when you should be talking to your guys about trading, right? This is when you start seeing that linear movement where if you're going to jump into the market at $150,000 combine, when have you gotten a good out of that machine as far as depreciation and value and all those kind of things go? Same thing on the upper end, same thing on the lower end. The conversation about trading equipment, obviously it's driven by cash flow and all those fun things that go into that. But this is the one thing I feel personally like, and I'm sure every banker out there is going to jump my ass about this, but I don't know if the conversations are being had enough to say, like, you know what, you've actually got a $200,000 machine here. Looks like to me when that machine gets to auction value for your machine gets to that $150,000 or $125,000 range, we need to think about jumping in and doing something different based on your situation, right? I just feel like that following that depreciation curve for machines and knowing when you're going to get to a certain reconditioning spot and a certain depreciation spot and where those lines cross at are a huge, I think, indicator of when it's time for you to trade, depending on your situation and your cash flow situation, all those kind of things. But when those two lines cross, that your reconditioning costs are going to outpace your depreciation, and all those things come together, you've got the good out of the combine. And either you make a big investment to bring it back up to speed, or you take that same amount of money you would do that with and look at upgrading your machine.
Yeah, it's pretty easy to look at this chart case and say, oh, you know what, I'm going to go buy a combine with 2,000 SEP hours and run it till 4,000 SEP hours because it's got less depreciation.
Right.
But you got a lot more reconditioning and carrying costs on that asset as it relates to something that's between 500 and 1,500 hours.
Yep, that's very true.
All right, let's let's dive in. Combines by manufacturer. More of a, call it, the model years we're going to look at in the next few slides will be kind of that 2011-ish to 2016, 17-ish time range. So good inventory, decent inventory depending on the manufacturer, and should be able to give you guys some good insights to what's going on. What we're looking at here is John Deere S600 series combines. Naturally, it's you based on price, you'd say this aligns pretty well for the value of what you're getting. S690s are at the top, S680s, S670s, S660s at the bottom. What I think is really unique here, Casey, is the inverse relationship that you have about that 2,500 hour mark on S670s and S680s. Guys are starting to pay more for an S670 than they would for an S680 later in its life cycle. And then that jump all up to an S690 in that later hour is really big. You got to, at a used market, you have to pay an extra 40 grand to go buy an S690 or instead of a 670 or S680.
Right. Which makes some sense because that's about the difference between the two. But there's when you look at the S680, excuse me, the S680, the number of 680s on the marketplace are still, I mean, obviously the 670 is the bigger group of numbers, just kind of looking at first glance at this chart. The tightness though of the 680 in the range from 200,000 to 100,000, that's where the biggest bulk of those machines are being sold at. If you look at that, how they kind of are smashed together. The 780, or sorry, the 670, the biggest bulk of them are in that 150 to $100,000 range. So it's even a tighter range than what you see in the 680 range. So that's an interesting thing, but I don't think there's a big shock there that the overwhelming majority of these machines being sold are between 1,000 and 2,000 hours across the board. I mean, the overwhelming majority of the 60s, 70s, and 80s all fall into that mix.
And they were probably all manufactured in 13, 14.
Yes, they sure were.
Okay, so this is the John Deere fleet of combines as we go into Case IH. So as you can see from the models that we pulled in here, there's 6, 7, 8, and 9 class combines. There's definitely fewer that sell at auction.
Yeah.
And I pulled in the 6130s, 7130, 7230, 8230, and 9230s. Just to give you a good representation of what's going on in the market for Case IH combines. Again, much fewer than you'll see on John Deere. But in the used market, John Deere has a 60% market share from every other manufacturer. I was talking to an OEM once, and he's very adamant that John Deere's combine market share is 60%, Case IH is 10%, and then the rest are the final. Case IH, excuse me, is 20%. I think Kloss is maybe 10%, and then the rest of them are the other 10%.
Right.
So naturally, you're always going to have more data, better data on Deere equipment than Case IH. And after that, it's going to be a little bit sparse, but every data point helps when you're evaluating equipment.
Right.
What I found interesting here, Casey, is the 6 class is selling better than the 7 class. Excuse me, 6130 is selling better than the 7130.
Yeah. That's another thing too in the Class 8 market here. And the case side of the business is significantly higher. Really, I mean, it's significantly higher than everything else they've got out there. The number of 8 model or Class 8 combines that they've got out there is there's more machines and they're selling for more money overall. So yeah, that's pretty, because you would think the Class 7 combine, especially in that that kind of that year range that we're looking at here, that 1,000 to 2,000 hour range, in 12, 13, 14 model years, they sold more Class 8s than they did anything else.
Yeah.
I expect that.
Yeah, there are a lot of those out there as it relates to the Case IH series. And the other thing I find interesting from this chart is the 8s and 9s trade pretty tightly together.
Mm-hmm.
And then if you look at that 7230, you kind of have to look kind of hard, but there is a lot of variability in price there.
Yeah.
I mean, if you're looking at that 1,600 hour range for a 7230, there's a few that have traded around that $80,000 to $90,000 mark, $80,000 to $100,000 mark, and then you have this one that's all the way up at 165,000. 165,000. Like, that's 2x the price of the ones that were selling same hour range.
That doesn't make any sense.
Must have been a very nice one.
Must have been something. That doesn't make any sense.
That price looks more like a land price in Northwest Iowa where two cattle and hog producers got together.
Yeah.
Had a fist fight over a farm.
Yep.
So the other manufacturer we want to take a look at is Kloss. Again, not a lot of data points, but these are enough to be somewhat statistically relevant as it relates to the Lexion 740 and 750. We haven't seen a ton of these at auction. That 750 has some variability, as you can see. That 2,600 hour, there's one that sold for 55,000. Well, 2,400 hours sold for 120,000. I personally, and I actually watched the auction that sold for 55,000. I'm not sure why that sold so low. That guy got a bargain. But as it relates to the 740s and 750s, I think you'd see the normal price gap between the two. It seems to be a little bit more extreme than you might think, though.
Yeah. Yeah. There's just not many of those out there anywhere. There's pockets, in certain regions of the United States, but in Canada, there's a fair amount in Canada, but there's just not it just doesn't have the dealer network. It's just not there for the classes that you see for the other manufacturers.
Yep, and it's going to take a special buyer to buy one. So if it's in the wrong location when you're selling it,
yeah,
there's no dealers around and nobody's really willing to ship it across the U.S. closer to where they might have other Kloss equipment, could be a tough sale.
Yep.
Maybe that's what we saw with that 55,000. I think it was down in the Kansas area, and it was an online only auction.
Yeah.
Okay. So the other thing I wanted to look at is kind of combines by class. So we just showed you by manufacturer what it does. Now let's look at them by class. And I based on the data you saw earlier, I thought it made sense to only bring in John Deere and Case IH to look at that comparative analysis and how it trades. Here you have your S660s, pretty traditional depreciation curve. You have your 6130s and 6140s. The 6140s were made a little bit more late model. I think they started making the 71 or 6140 in 2017, 2018.
Yeah.
Where in 2017, 2018, you would have jumped up from the S660 to 760. That's right. In 2017?
Yeah, 2017.
But we wanted to at least have these in there so you can see the 6140 over the 6130s in the auction market. S660s are much more prevalent in the class 6 combines, and people are paying more for them when they're low houred, And then you see the inverse for the Case IH later in life, maybe a little bit less depreciation on these. And it could be a supply issue as well.
Well, I'd go with the supply thing. You got 1, 2, 3, 4, 8 data points between the 6130 and the 6140. But I will say this, the 6140s are a pretty tight group for what they are. I mean, the hour range between 800 and 1100 hours. You have a pretty tight group there as far as what value brought.
Yeah, if you look really early on, there was a 6130 that sold for 170,000. Only had 250 hours on it.
Yeah.
Whereas if you look at the really low-hour Deere machine, you've got to pay another $50,000 to $100,000 to go get into one of those early on in life cycle.
Yeah. Yeah.
All right, let's go into Class 7s. Class 6s are okay, but Class 7s and 8s are where the kind of meat and potatoes are in the data here.
Yeah.
So Case IH, Claas, John Deere. You specifically watch the values, go John Deere, Case IH, Claas. And, you know, we've seen a good number of, or a few Lexion 740 sell in this graph. Quite a bit more depreciation on one of those than what you look at a Case IH or John Deere. Is this surprising to you, Casey?
No, I don't think so. I think, again, it goes back to that, to the dealer network thing. You know, it's what I mean, the cost, there's less machines there, and at the pocketed areas that they have strong Lexion presence, as far as dealer network goes, you're going to see higher values for machines just because the network's there in place. But as an overall North American, model, obviously there's more Case in John Deere dealerships in North America than there's anywhere else, any other brand.
Yeah, the other thing this graph makes me really look at are how similarly paralleled the S670 Deere machine and the Case IH 7230 is throughout the depreciation and life cycle. They depreciate at roughly the same rate, and that Deere machine is always going to be, maybe 10 to 15% higher in price over that Case IH machine throughout the entire life cycle.
Yeah.
From 500 hours all the way out to 3,500 hours.
Yeah, that's true. Yeah, there's never and as it gets older, it expands. I mean, that percentage gets higher. Yeah,
to a point. I also think the trajectory of those depreciation curves early on in the life cycle, there's still a good gap, but I could tend to agree with you from a little bit. And then as we look at the Class 8 combines, it's a little different. I think the first thing I look at is that glut between 1,200 hours and 2,000 hours, just like we're saying earlier. Guys are paying a lot more for that low-hour machine. Right up front.
Yeah, and that kind of goes like just like we talked about earlier, that the demand for that low-hour unit is there's plenty of it, because I don't want to say there's none, and there's a low supply, because there's it's not where it needs to be at for it to be as effective as you would think, as far as if you look at this graph, the number of machines that are above that $150,000 mark and up, and the number of machines that are from $150,000 to $100,000, it almost feels like there's about the same number of machines on both sides of that. If you really look at it, there might be a few more in that 150 to 100,000 range, but there's still a fair amount of machines that are 150, 200,000, and what that looks like, and just those are the ones that have probably less than 1,000 separator hours on them, that above 150 range. So that's what folks are looking for. They're trading their 2,500 hours in on 1,000 hours, or their 1,500 hours in on 750 hours or 500 hours or something like that. So
if I understood you correctly, you're suggesting to trade in that S680 before you get over that 1,200 hour mark.
I think so. I think any combine that you get over, that you can get 1,200 separator hours before you hit 1,000 separator hours. Because that's really, that 750 to 1,000 separator hours is really your biggest spend in reconditioning costs. Your first biggest spend in reconditioning costs. And then every year after that is another, you start hitting reconditioning points on after that. And it just depends on what your operation is like. If you can trade your combine in and you can run it to 750 separator hours, whether it's case, deer, whomever, doesn't matter. You're going to get the most bang for your buck. That's going to be your cheapest to run that machine. Because after that, the reconditioning costs are going to catch up with depreciation.
Yep, and you know, if you don't look at the linear graph line on here, the logarithmic graph line here, and you just look at those S680 dots that kind of make an S curve between 500 hours to 1,000, pretty flat depreciation.
Right.
And all of a sudden, that 1,200 hour, you significantly drop in depreciation, and then it kind of flattens back out. I mean, if you just look at price, you're seeing those 500 to 1,000 hour machines selling in that 225 to 275,000 range. So call it low to mid $200,000. And then right when you hit 1,200 hours, and in 1,200 hours, they just drop significantly. Between 1,000 and 1,500 hours, I'd say a majority of them in the $150,000 range. It's just a S kind of curve going down right when you hit that 1,200 hour range.
Yep.
The other thing that surprised me on this was, as it relates to the previous graph, we were kind of dogging Lexion 740 combines, and they don't sell very well. Lexion 750, their Class 8 combine is holding in with the rest of the pack here.
Yeah.
Selling better than Case IH's 8120 and pretty close to the 8230 Case IH and the Deere S680. A little bit cheaper, maybe about 15% cheaper, but it's also 15% more expensive than 8120.
Yeah. The Class 8 combines, I think, are the combine that more people are gravitating to. It's not too big that you can't get it around, but it's big enough. It's bigger than a 6 or 7, and it gives you that little extra amount of capacity to get things done faster. To me, I think the Class 8 combine right now in this marketplace is a sweet spot for combines. Well,
you get that operating efficiency in your farm without paying a Class 9 price.
Yeah.
Class 9s, we can also look at a little bit fewer data points. Here we're looking at Case IH 9120, 9230, and then John Deere's S690. Again, as relates to every other graph you've seen, the Deere machine is more expensive.
Yeah.
And here you see a pretty similar graph, linear depreciation between a 9230 and an S690, but you have to pay, what's that, 1,500 hours. I'm looking at $100 and probably $30,000, maybe $135,000 for a 9230, and then or you got to spend $190,000 or $200,000. Well, really $200,000 for an S690. So you're gonna have to pony up another $65,000 to buy that Deere machine over a 9230.
No, that makes sense.
There can't be that much difference as those machines being new. I tend to gather they might depreciate a little bit quicker. or have less of an audience later in their life cycle.
Well, new programs affect the price of used a lot. And as you watch programs and how manufacturers roll out different stuff when it comes to selling new and what they decide to do at any given time. I mean, whatever the program is from on the new side, it affects used probably at least by twice that much. So that could have an effect on what you're seeing here as well.
And you also see it looks like a custom harvester had a couple of 9120s.
Yep.
Ran them all the way to 4,400 hours. And they sold for, same auction sold for about $41,000.
Yeah. Got the life out of those.
Yeah. Well, Casey, that's the data that I have on the combine market. As it sums up, I think a few things that I look at are that Deere machine's always more expensive. There's a heck of a lot more of them. And then as you mentioned, you're looking to trade or you're looking to sell, you're going to have that value at that $500 to $1,000 range. But then once you hit 1,000 to call it 1,500 hours, you see a big depreciation in all of those machines, regardless of color.
Flip back to the chart you had. We had all of them, by class, kind of lined up with each other.
Yeah, sure. You gotta bear with me on my transitions here. You're looking for this graph, aren't you?
Yep. Yep. So you have all makes, all models here in this graph line. This is one thing. Again, bankers, if you listen to this, pay attention to this graph. This shows you where the depreciation is for the machine, what the depreciation looks like, and when you've got the best out of the machine, right? There are depreciation points and reconditioning points that need to be understood. And when you're talking with your customers, this is when you need to have that conversation with them. Where are you at in the depreciation curve? Where are you at in the reconditioning curve? And reconditioning is one of those things that, in my personal opinion, the only time reconditioning comes into play in a piece of equipment, it is a combine, it is a chopper, it is, I maybe throw balers in there to some extent, but overwhelmingly, my personal opinion is it's combines and choppers, harvesting equipment. And the reason for that is those machines are either A, ground engaging, or B, they are running a massive amount of product through them. And there's just a million wear points on these machines. So when you're talking with your customer, understand where the reconditioning points are for combines, understand where the reconditioning points are for choppers, understand what the depreciation curve looks like. And what Kyle's putting out here gives you all that information. Reconditioning obviously is not in here, but I mean the depreciation curve and what that looks like. And if you're going to take a brand new combine and run it all the way through to 6,000 hours, on the depreciation curve, it might make sense to do all that. But the amount of reconditioning that you're going to do in that time frame, you could probably buy 2 new combines doing that. So just be aware of that and understand what that looks like, and hit Kyle up and how he can get you this information. So with that being said, Kyle, what's the best way to get a hold of you and the folks there at TractorZoom and Iron Comps?
Yeah, certainly. The other thing I'd mention, Casey, is you've got some pretty religious listeners on here. There's specific things that you guys want to see that you can help us form our next podcast. Shoot Casey a note. Shoot me a note. Best way to get a hold of me is, you guys are welcome to shoot me an email at kmcmahon@tractorzoom.com or call my cell, text me, whatever, 641-919-5953. And then if you're looking for farm equipment coming up for auction, so you're looking to buy something, go to tractorzoom.com. You'll see auctions coming from 400 different auction companies across the United States that advertise the machinery on there. You can sign up for alerts. Let me know when an S660 comes up for auction, and I'll literally text you. or let me know when an auction comes up and 200 miles of me. I want to know about every single auction. It'll text you. It'll email you. It'll send you a notification on your app, whatever. You could also go to Iron Comps, and that's where we're actually using a lot of this data visualization here. We're looking at we're analyzing over 4,200 auctions that have happened in the last 2 years, and that's how we form our data.
Right on. Well, Kyle, this is great stuff. I think this is it's a game changer as far as how used equipment guys like myself and my team can go in and really start to kind of pinpoint where we need to be at in the marketplace and what's happening in the marketplace. Way more important about that. I mean, understanding what's happening in the market and seeing these trend lines develop. So, Kyle, thanks for being on the show, man.
Yeah, thanks for having me, Casey. Looking forward to see what happens to the auction market as COVID and people start getting back to work. I know our team is antsy to get back to work.
Yeah. Well, I'm Casey Seymour with Moving Iron Podcast. Make sure you check me out on Facebook, Twitter, and Instagram for all the latest podcast drops as well as blog drops. I'm actually writing one right now, and I'll hopefully have it done this weekend. Check out the Global Ag Network and all the great podcasters out there as well. And I know it seems like there's a lot of negative things going on in the world right now, and there are plenty of them. But things are turning around slow but sure. Check out the podcast I just dropped there yesterday with Sean Hackett about what we're talking about happening in the marketplace. So I think there's some silver lining coming, folks. So just keep your faith and hold the line. And I know it's tough to say that right now, but there's a lot of positive things coming. So with that being said, I'm Casey Seymour with Kyle McMahon. Let's go move some iron, folks. Out.
Moving iron in the 21st century.